Good afternoon. For those of you joining us for the first time, my name is Roy Weiler. I'm the Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, please give us a call at 800-519-9085, and we can send the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can share a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent Introducing Brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our beta group Spread Strategies Follow-Up webinar. Mr. Mueller?
Thank you, Roy. Welcome to today's session. This is a more advanced program, so if we have any beginners, please hang in there. You can ask your questions later. Just to summarize, we work the program through 4 levels, and today we'll be working on the master combination calculator, which can work on all markets, stocks, futures, and options. Most people need to start here with the basic stocks and stock option calculator, the basic futures and futures option calculator, and then progressed on to spreads and the all markets version. This is our way to test everything. Again, the way the system works, let me show you very quickly. You can search your trades by market. So we did a short review previously on the various resources that are available in this market. So let's say somebody wants to start by looking at one of the energy markets. They can select the market from the Market tab. And then, for instance, let's say they want to look at crude oil. They're going to go to a specific crude oil page. As you can see here, we're going to have all the tick values as well as the important factors. It's not a complete list. I'm sure there's always something else, but it's very comprehensive. Look at Venezuela being listed even before the event. A lot of the other weather and geopolitical factors, the regular supply and demand reports, all listed here, many with a link to the primary source. So whether we find a trade in here, selecting a market, or once we have an opinion, we go to the strategy gallery, and this is how we selected these trades. Each one was selected looking at 2 key parameters. One is direction, having an outlook of whether a market is anticipated to go up, whether it's anticipated to go down, or to work its way sideways. And the second major factor that is considered in deciding on a trade, and this is something that is extremely underutilized, is the volatility scenario. So we also created a volatility expectation, or at least hypothesize the volatility expectation, and then would come up with a trade with both those principal inputs in mind. And again, let's say, for example, and I know that we have some of these today, each one of these trades that is listed by direction and volatility. So, for example, somebody who is undecided about a market, doesn't know where it's going, the only thing they know is that they expect volatility to fall, then they see the 2 alternative trades for that position. We're actually going to have a program on this tomorrow, and then they can click on that particular trade, look at the particulars of where the trade works and it doesn't work, with a very specific discussion of profit, risk, when to use, and of course the most important thing, straight language about what your profit potential is, what your loss potential is, and speaking of volatility, the extremely important misunderstood factor of time decay. And there's a short narrative on the details if you need it. You can always keep clicking to these things, and then let's have a look at some of the trades that through this process, we've had some of them sent in my clients. Some of them were strictly for hypothetical purposes to illustrate different types of trades. So for instance, well, nobody wants to cherry pick, but actually this is actually a trade in the soybean market. We looked at a ratio trade. So this could be a plus or a minus. This particular trade is a ratio call spread. If somebody doesn't remember where what the scenario was for putting on this trade, or you don't have your notes, then you go back to the strategy gallery. You can click on ratio call spread, and you already know that your outlook was that the direction was going to be bullish, but the volatility was undecided. So in that particular example, when you're looking at a ratio call spread, you are looking for the market to go up and the volatility to be diminishing. Now, since this market rallied significantly, so it did go up, the direction was correct, but the volatility went up. So anybody was in a trade like this, let's see where their values would be intrinsically right now. They bought one soybean 1320 call at 37. They sold two at 20.5. So let's look at the particulars on this trade. Okay, their break even as we can see here was at 2.9. Actually, this trade was actually done at a credit, and as you would know now, the 213.60 calls are intrinsic, so you would have to revisit your scenario. These are on the May futures. The May futures are now at 13.97, so the additional short call is intrinsic 37 points. Let's look at where intrinsically the spread would be right now at 13.97. Let's see. Based on intrinsic value, the trade would still be in the general range of profitability. But based on time, on the volatility increasing, this spread right now could be upside down. So one would have to be pretty convinced that this market is going to stall out or stop here, having options written right near the danger zone where intrinsically they could start losing more than they're gaining underneath. In a case like this, you could adjust the position. Again, there would be a possibility of rolling out some of the risks, saying, well, I'm willing to have one option at 1360. I'm not willing to have two. So you can always offset. You can come out. Or if you like the position, if you say, well, this is all volatility and it's nonsense, and I think the market's going to stop or it's going to pull back to about 1380, 1370, that's fine, as long as you can afford the risk of your convictions. And let me show you why that is, because this risk is a margin trade. You are losing on the second option. Your risk becomes unlimited. So if there's a huge breakout to the upside, one would have to be mindful of the risk. And I'm actually going to increase the number of rows here to try to visually present a more complete picture of the risk on the second naked option. So for instance, if one would believe on any scenario that this market can find its way into these loftier numbers and these levels of loss become unacceptable, then you have to start thinking about either offsetting the trade or making an adjustment for an additional up move. And this is where we go right back to the strategy gallery. So if somebody felt, well, I think this market is going to continue going up but with less volatility. By starting a small position, you can overlay an additional position on this and try to neutralize your risk on a rally while capturing as much volatility as possible on the time erosion. So let's just see, for argument's sake, again, we go back to basics. We look at a trade. Okay, we still think the market is bullish if one thinks it's bullish, and you can apply any of these scenarios and change or adapt this trade other than offsetting it. and see how that affects your outcome. So let's say we felt the market is going to continue to go up, but we think the volatility is going to go down. In many cases, there are, again, we see two possibilities here. One of them, if on high volatility, is to collect premium on a put. This is a margin trade, but it further collects money against an upside move. And again, you are looking in that case for falling volatility. The other is actually the trade that you have, but it's deep in the money, which is ratio call spread. And oddly enough, correspondingly, that's what you started with, and the volatility went too high. Now that trade still works if the volatility goes down, which is just what we discussed. So we can look at the middle of a trade as it is. Let's say somebody thinks, well, I think it's going to continue to go up, and with rising volatility. Well, you got bullish, and one of your first choices is a long call. So in that particular scenario, again, you sold two calls. The most bullish thing you can do for rising volatility is buy a call, and that's exactly what you can do. You can buy any call. Maybe you want to buy one into another deferred month so that you can have more time to catch a move and catch erosion on the second naked option. You have to look for a calendar skew in that. Or you can actually, and it's the most economical thing to do if you like the strike price and the month, you can actually buy back one of these calls. This way you pay nothing because you're offsetting an existing position, and your remaining position then is going to be a one-by-one call spread, in which case if the market stays above 1360, the second option is gone, you're going to be able to keep all the money. So let's actually show how, so you would be able to collect at expiration, if the spread is intrinsic, let's say 40 points minus your costs. If the position is exercised. So if you're collecting 40 points, then your gains would be 40 plus the 2.9 in premium that you collected. That's 42.9 minus whatever you would have to pay for that additional call at the strike price of 1360. Now, do we have a settlement price on that second call?
That's a May 1360?
That will be a May 1360. It's in the money. So again, it's a highly valued option. So let's see what would happen to the spread if it expires fully intrinsic, but we invest in buying back that option. Again, these are just ideas to review how these spreads work and how the volatilities work. I actually am not looking at any real-time trade that has this particular composition.
It's settled at 60 and a quarter.
Okay. So anybody who buys back that option at 60 and a quarter today and would be writing out the other call spread would be locking in a loss. So which is okay, and taking the further risk of the market dropping under 1360. So just doing that math and having that math in the spreadsheet, and we can input a trade of buying the call or changing this to a bull spread and adjusting the costs. Again, you just have to go into the master calculator and just change the composition of the trade. So let's say instead of a call spread, which is 1/2, as we indicated previously, you can change it to a 1/1, and then we would change the premium on the option that is sold accordingly so that everything adds up. So if it's 60, obviously you would go to 80.5, and this trade would show itself to be upside down in a very broad range. So, but let's just look at the first trade first as initially having been a 1/1 as an alternative strategy. Now that we see that somebody who had undecided volatility on the trade and a bullish outlook at this particular point would be intrinsically maxing out on the trade. So when we mentioned the significant difference in volatility outlook, here we have one spread from 1320 to 1360 that at this point is intrinsic, it's in the money and it's gaining, and the other trade would be having to handle a naked second option. And again, it could be covered with the futures. There are a number of ways of covering it at less cost and adjusting. And that's really the type of thing we'll be doing in webinars. We'll explore different options, such as, let me go back to the original trade, such as we just went through the one example of just buying back a call. The additional examples that we can go to as we continue will be to look at different types of spreads and different adjustments, and if somebody's in a real-time trade, you keep comparing these spreadsheets. So now let's go to another couple of markets that have been very, very interesting. The bond market has really bounced down, bounced up, has been all over the place. There was a short strangle, I think, that we showed on the 13th. And let's see that we did that short strangle. The market was up, it was down, but it's kind of still floundering it somewhere not too far from the middle of that range. I'm curious how much erosion we caught on these options. We did the entire spread, collected a net credit of $550, call it $460. And how much are those options worth today? These are the bonds.
The 137 call is at about a half a basis point.
Okay, it's up a bit. I'm sorry, and?
The 126 put is at about a quarter of a basis point.
Okay, so this spread with time erosion and all, because there's been some decent volatility, this is a short strangle which looks for the market to stay in the range. And as you can see here, although the market has stayed in a range, and this trade has already been working for close to a couple of weeks, although it's in the middle of that range as before, the 1 week this didn't do a great deal to time erosion, because bonds, which have been trading in a very narrow band, have traded in a broader band, so there's been a slight increase of volatility, where there's still an unchanged level of expectation by option buyers on the call and put side that this market could really go places. So as long as that anticipation of big moves is there, or there's a sufficient anticipation, these short options erode more slowly, don't erode, and they haven't, but in theory they can appreciate as well. And I think that we can probably see a very similar example in the note market, although the notes are nearing certainly closer to the call strike than the put strike, and this example was done on the same date. And let's look at the values. We did them at 31 and 33. Again, this was a short strangle, looking for a flat zone in the middle. And what are our values right now on premium there?
I believe that was a March. Didn't that expire on Friday?
Excuse me, just a moment. Let me look at my notes.
I thought it was a March 10-year notes.
Shorts. Oh, here. Short strangles. It's under short strangles. Just a moment. Just a moment. I think that this was in an earlier set that we no longer have saved to a tab, but based on this being on the 13th, I think that would make sense. So we'll have to make sure that we note these things on the tabs. I think we did it on a number of the strategies. We have to make sure that the tab indicates the month of the trade. But indeed, if it was in March, and the numbers are pretty close together to suggest that it could have been based on the day was set, then that trade would be a complete winner and would have expired worthless on the edges. Let me just look. I see, and we did actually something very similar with the E-mini. Just a moment. And I think in this particular case, we were demonstrating a large risk, of course, in the markets on a move in either direction. And we had a range from 1650 to 19. And obviously, that range is, still well within that range. And I believe that that position expired worthless as well. I believe this may also have been done in conjunction with the discussion of one of the practices of certain money managers, CTAs, private traders, to write extremely out-of-the-money short strangles for small amounts of premium with very wide ranges of profitability and a correspondingly high degree of risk. And how surprisingly enough, and we follow some of them, how when you look at this thing, it's very difficult for an individual trader to to look at some of these numbers and say, well, I can make 245, but if the market goes to 1,400, I'll lose 12,000. You know, it's so few private people really see the sense in doing like that, and yet, you know, using the calculations, the statistics, some of these money managers do write these options and do these types of strategies. This is a very cheap short strangle, collecting very little out of the money premium. But again, at the time frame that you're looking at, some people will follow that. If you do this yourself, you must have risk tolerance and watch the market extremely closely. Otherwise, it's going to be very difficult to handle a short strangle account. Last week, and I think when we did our discussion of short strangles, we have an entire program that's going to be devoted to that tomorrow. It's extremely important to understand the difference between doing these short strangles naked or perhaps looking at another strategy, something like the condor strategies, which you can see in our dynamic strategy gallery, in which you can have the advantages of selling these out-of-the-money options for premium that you know, these options, according to the regulators, anybody who contemplates purchasing deep out-of-the-money options should be aware that the chance of such options becoming profitable is ordinarily remote. I think that's the actual wording, that when somebody buys deep out-of-the-money options, their chances of making money are ordinarily remote, and the statistics do show an extraordinarily high percentage of such options expiring worthless. So there is certainly appeal to writing these options. Of course, it's for people who have the risk tolerance. If they don't, they can go to trades such as the condor and different kinds of credit spreads, in which you still have the advantage of collecting premium, but you also can cover that premium with some other options. So let's say in a case like this, and again, it's a small number, we'll have to see a larger S&P example, but this will suffice. Let's say as the numbers increase exponentially, somebody might say, well, I'm going to buy an option here and cap my risk. And you would be giving back some of the premium that you've collected, but you'd also have a much more narrow range of risk in either direction, because all naked premium, all naked options would be covered by other options farther out of the money. So this is a way of taking advantage of the statistics of keeping premium and also mitigating or reducing the level of risk by assuming that responsibility. The other market I wanted to look at very quickly, and I know that the...
Before we move on, we do actually have a question about that strategy. What about placing buy stops on futures contracts on open orders in case the short options get out of the box?
Okay, just a moment. I think that's a very good question. Repeat it slowly. Hello?
What about placing buy stops on futures contracts with GTC orders, open orders, in case the short options get out of the box?
Okay, that's a very good question, and it is a strategy that is commonly used. So let me go back to this example, and using the example of the soybean trade that overshot the 1360 strike price. And again, that's just one of the ones we picked. I mean, we had in the bullish soybean tab, this started out as a 1-by-1 trade, and I think it was saved as a 1-by-2 to show a ratio spread. But whichever way the trade was initiated, here is the number one problem. And I always want to mention risk first, because if there's an element of risk to a trade that people don't understand, then they shouldn't do the trade. When you buy a futures, if you use a buy stop in the futures, that, as with any market order, it does not guarantee you a fill. So let's say you have this trade put in, and you are in the market, and you have a ratio spread from 1320 to 1360, and I'll just say arbitrarily that you put in a stop at 1360 to buy the futures, if the market is below then when you put on the trade. Well, first of all, I can tell you anecdotally from the size of this move that there was time to make other adjustments in real time if anybody actually did this trade, because although the market was very bullish with rising volatility, it was a disciplined rally. So certainly buying the futures at any point, in addition to doing a stop, was one possibility. The risk is if you do it as a market order, you have a stop in at 1360 on the futures, and you put it in when the market's at 1345 or 1340. If something happens, and again, we may or may not think of a scenario, but if something happens and the market gaps open the next day and is locked limit, then not only are you not going to buy the futures at 1360, you may not be able to get the futures at all. And in fact, theoretically, if it's locked limit again the following day, then although you have a futures order in, you are not guaranteed or assured to fill, because a futures stop, in this case it would be a buy stop, is a market order. Now, of course, I'm talking about an unusual case, but it's not a case that shouldn't be considered when you select your strategy. That's why some people, if they put on a trade like this, might do a variety of things. One is if the market doesn't gap open, multiple limits in a row, they would perhaps alter this position using options, maybe rolling up the 1360 call, doing some kind of a more deferred call spread that would cover the risk without having that unknown dimension of not being filled at all. In fact, if you had an order in the futures at 1360 and the market gapped past your position, one of the things always to consider is that you can trade options on a limit move. In fact, that's one of the ways to try to figure out just how much is the market going to go after a limit move, by figuring out the value of those options. So let's say if there's a limit move and that futures wasn't filled and the market gapped past there, you would still be able to execute transactions on the option market as long as the market's open at all. I mean, I'm not talking about some global catastrophe that shuts down all commerce. So, but in the event that that the futures are locked, the options will trade, and you can use other option strategies. The other thing is you can use the futures and have a backup option strategy, because again, if the market is locked limit, you can try to cancel your order, and that again depends on your relationship, your platform, how you get that done. So, so I would probably say for somebody who absolutely, positively cannot tolerate that naked option risk, either shouldn't write it, because covering with the futures is a good strategy, but it's not a strategy that will remove a fairly substantial amount of risk under extreme conditions. The other thing a person like that can do, again, so two 1360 calls, did the trade at a small credit, person like this could go ahead and say, you know what, I'm got a 1360 naked here, but I've got a 40-cent spread from 1320 to 1360. And of course, before the market takes off like that, instead of buying the futures, which may or may not be filled at their price as a market order, and again, it's a good idea. Buying futures using stop is textbook, mainstream planning and strategy. Nonetheless, I'm just saying for somebody who absolutely can't afford for that strategy to fail and for something to happen in the futures, be locked up, somebody can buy a call on top. Again, as we discussed covering, this would be a butterfly. So maybe they can do a 1320, 1360. It's done at a small credit, as you can see, and you factor in commissions, etc. However, if you buy a 14 call, you reinvest a little bit in the market, your risk is capped at 14, and even if the market gaps through your number, even if it explodes for multiple limit days, you have the right. Now, it's not a market order now. You have the right to exercise and buy futures at that strike price. And whether or not the futures are up limit or they're not limit or whatever they are, you own that call, you have that right. That is the difference between being the buyer of a call, where you have the rights and not the obligation, versus the writer of a call, who collects this money, but he's taking on an insurable risk that he's going to have to pay off under certain conditions. So in a case like this, you combine selling and buying, in essence reinsuring some of the risk that you took by having a naked call. Any other questions?
Are stop limits still valid orders like they used to be?
What you should do is to look at each instrument. The answer is sometimes, and here's why I don't have a general answer. You have to, number one, if you're trading with a broker, you have to find out if your broker has that kind of an access to place a stop limit order, and in what markets. So I think that really depends on who you're working with. You know, is it something that's all electronic, that's going to be platform-based? If it's something in which you are working with a human being, perhaps somebody in the remaining pits, or somebody who's still involved in open outcry, then it's a question of whether or not they will execute that type of order. Sometimes the best, I mean, so if a platform doesn't do it, then either you or somebody who's on the screen all day, what I would do is the next best thing is to set an alert when the futures price is hit, and then have the person call in a limit order or place a limit order electronically, you know, and also see if you can do it as a contingency order, that if this price gets hit, it sets the alerts and go in. So this is where you really have to know who you're working with and what the different types of orders are that are available. We do have a very helpful brochure called How to Place an Order and Enter It Correctly. If I could find it, I probably would show it to you now, but it's in another folder, and we're in our option range review. But again, when you have a question like that, just email us and contact us, and we'll get you the info. Be sure to look at the video, How to Place an Order and Enter It Correctly, and then confirm through your own execution platform or broker, whatever, what types of orders are available to you, and discuss how you can execute them. So any other questions? By the way, the other distinction between different types of orders, whether it's a futures stop order that we just discussed or a stop limit order, you should really be sure that you have all that information in advance and plan out those trades and that they're available to you. And for those of you, by the way, who don't know what a stop limit is, I'm sorry, let me just summarize that. A stop order is a market order. It means that when a market hits a certain price, you get filled or executed at the next available price, whatever it is. It can be higher or it can be lower. It can be exactly where you had it. And again, there are reasonable ranges for this to happen. So if you put in a market order and the execution price seems outside the range of what is reasonable, then you should look into it, and you should have your, if you have a broker, have your broker look into it. You can look at a time and sales so that you can see if the time within which your market order should have been executed, the trading fill that you have is reasonably within the range that was trading and executing in at that particular time frame. So that's one thing. So a market order, a stop is a market order. You know, you'll get filled somewhere, not exactly at your price. You're not guaranteed a price, but you are guaranteed to go to the market. When you place a limit order means that you may or may not get filled because you're going to say, I want this or better. So you say, I want something for $800 or better. So if the market doesn't trade at 800 or above, or doesn't trade above, or there's no liquidity and all the trades are below that number at 795, not 798, whatever the number is, then you're getting your way in terms of setting a limited price, but you may not actually get in or out of the trade because now you're making a condition. The limit is a condition, and if the condition is not met, meaning that price doesn't go beyond that and you're not in queue to get filled at that price, there's a possibility of not being filled. So these are the two countering points of a stop order and limit order. Stop order gets you in or out for sure. The price is iffy. A limit order gets you your price, but the execution is unsure. A stop limit tries to get the best of both possible worlds. It means that once a market gets hit, at a given price, you place a limit order. Now, the same thing as with any limit order is that although you had your stop hit, now you're making a limit. If the market does not go towards your limit, then you may not get executed. So you had an unexecuted stop because you turned the market into a limit order when it got there. So in both cases, the limit does not just give you a limit as to getting your price, it gives you a potential limit as to executing your way in or out of that market. I think, again, you should know the liquidity of what you trade, have a look at volume, open interest, the bid and ask spread, and then you're going to have a better sense of what kind of orders will best serve your interests. So, you know, in a hugely moving market, sometimes a stop order will get you a bad fill, but it will also make it clear where you stand so that you can regroup as needed. Any other questions?
We have a couple of roundup questions I've been holding for you. Are we going to do another webinar on the VIX?
Oh yeah, the VIX is actually, the stock market has really quieted down. It kind of dropped. People got nervous. Then it simmered down. And if you just, I'm actually going to pull up a March chart just to give you all a sense of it. So I think we will be doing a VIX webinar sometime this coming week. As you can see, the stock market here was moved into a fairly wide range relative to some of the previous ranges, and now seems to be quieting down. Look at the volatility down here. The volatility has gotten back to a pretty low level, so we're very curious if there's going to be another test to the downside or not. So the volatility index is a very interesting indicator if we think that something else can happen in the stock market, especially to the downside. So although it's kind of resumed an uptrend, the trend that seems pretty steady in the short term here, and you can look at the different time frames. Again, on the weekly, we're pretty much near a top here. So perhaps oversold. So we look for indicators of how to use the VIX. People don't know the VIX. Primarily, what we are going to do is we want people to see how the valuations move around in the volatility contract and how to correlate it to different levels of risk in different markets. So we're very mindful of that market, and I would think sometime next week, in all likelihood, either Wednesday or Friday, we're going to do a program talking about the VIX, the tick values in the VIX, and how different ways that the VIX, which is strictly a volatility index, how to use it as a way of looking for panic situations, dramatic situations, to pick a gain in the VIX rather than try to be short the market for a big drop or finding a large explosive rally. So we're going to look at that. We're going to go over the instrument, the tick values, and some of the longer-term incidents that have occurred in some of those markets. So, yes, any other questions?
This is in a similar vein. How do I get more information about volatility?
Okay, I think, well, in addition to the VIX, in which there's going to be specifically a discussion about volatility and the events associated with increased volatility, I would first of all refer you to our reference materials. Look at option sheets. Our option sheets define in, at, out of the money options and time value, which is also the premium, the volatility premium, other than in the money premium. So go here for some good definitions. Also go to our demo videos, in which we are very specifically discussing volatility in the context of different types of trades and scenarios, and again tying that discussion of volatility right back into the strategy gallery and the different strategies that go with them. We also, I believe that we have, and I may be mistaken, a demo video on volatility, and it's one that we're going to redo anyway, so you can either look for it in our demo video section, and again we have a pretty extensive pretty extensive selection of demos on how to input trades, on different types of strategies, buying calls, selling calls, combinations, short strangles, different outlooks and so on, how to manually enter trades, how to use different features. And I do believe that we have a program on volatility, but we will probably do a volatility introduction along with the VIX webinar that week. So be on the lookout. We'll be sending out notices. We're finalizing our schedule tomorrow, and the VIX and volatility will be on the list either in the same program or in two separate programs. And again, anything that you miss, if you're logged in and you're registered, you'll be able to see the video afterwards. And if you have any questions, as you can see, you can submit those questions. We're going to get to the answers either individually or in some kind of a forum. But we're certainly here to answer any questions that relate to the program. Anything else?
We have one last question. It's a really general question. How do I set up a paper trading account?
Okay. Well, there are two ways of doing this. The first feature, which I think everybody has already seen, is that we really have, just a moment, that in all of the calculators, we have the saved tab features, so that as you can see here, you can save your trades and monitor those trades and update the values manually, which I think is a spectacular exercise to get familiar with tick values and also to calculate and see the spread values changing. The other thing that, so number one, you can save trades in this tab. The second thing that we will have, and it's probably after we finish this first round at the end of next week, next week we're beginning the basic strategies again. Within the next 1 to 2 weeks, we'll be making available a fully functioning platform as part of the beta test that you can try for a couple of weeks. You'll actually be able to input your trades there as you do here in the option ranger, but in this particular case, the trades are going to be updating in value 24/7. You're going to be able to view the transaction on account statements the way they would look on a real statement, so that you can get familiar with how a statement looks, how the online reporting looks. Make sure that you're monitoring positions 24/7, understanding values, and that way it'll be easier to coordinate based on real premium, when to offset, when not to offset. And of course, you'll always be able to send a question, post a trade to our forum, or to send some sort of a question to us. As you are aware, you can use the email feature. You can use you can save it under a tab and send it to us. You can post it to a forum. There's always going to be somebody who's a developer, a senior user of the software, who's going to be on there monitoring and answering questions, along with, of course, other people who are participating in the forum, so that we are going to have a real exchange and a real discussion there. So what you will have is, in a couple of weeks, in addition to these features, we are going to have a real-time platform. We're reviewing the final format, so it's the most user-friendly. So we are finalizing between a few platforms that we think are not just user-friendly, but that explain things in a good manner, give a clear indication of profit and loss and where your account is, especially on spreads and margin. If you're doing margin, you should have a sense of how these trades impact margin in real time if you're trading margin. And also we will want to look at things that have a relatively user-friendly execution component for down the road, so that if you decide you want to do these things electronically, you will already have been using something and getting a bunch of practice with it before you try to input any real-time trades and run the risk of making some kind of an error or having some confusion on a fill. So we do want people to have access to something that's going to have lasting benefit in terms of knowing how to do things electronically. Any other questions?
No, that was the last one I have today.
Okay, outstanding. I thank you all for attending. We've got some very exciting markets. I mean, I think we've certainly seen the importance of following things through in real time after we finish our beta periods. For instance, when we're going to be looking at any trades, if we're going to be inputting trades, we'll have a regular follow-up, not just for demonstration purposes, but we'll have to have real follow-ups of trades and follow-up adjustments and different alternatives on different types of trades so that we can do this on a very timely basis. So right as soon as we come out of beta, if there's a trade that we model and something happens in that trade, or some people save that trade to their own tabs, which means that they want to get alerts if something's moving or strike price is hit, then we're going to have all that very well coordinated so that we can respond to things in real time. And for instance, if John Q. Public has this particular trade, and we know because we have the same tab, or we know that trade is in the simulation platform or is trading in a real account somewhere, then we would know for a fact if, let's say, if one of these strike prices comes close, we'll immediately have access to that information to work up a follow-up strategy. We'll either be able to communicate about it or email it or save it to a tab with some notice, so that we'll be able to follow these things with a real-time type of approach to have as realistic as possible an indication of how these strategies and adjustments are understood, and specifically what trading style, what type of transaction, what type of activity is appropriate for everybody, not just from knowing the trades, but also from the standpoint of personal financial objectives and risk to reward expectations. So I think today was thank you all for participating. I certainly see that we have to do a more systematic follow-up in our next sequence, and although nobody sent me this kind of a indication, I see here that this is a lot of trades to follow. I think we'll have to set up more in individual tabs for individual people based on markets, and then we'll divvy up those trades accordingly. If anybody else has any suggestions, please let me know. I think today was real productive. Thank you again for being there, and thank you for the really good questions. We've had some outstanding feedback.
Okay, everyone have a great afternoon. Thank you.